Okay, hello everyone. Hope you've had a really good Christmas and you're all doing okay. I'm just going to make a series of videos for the first week because you may well be travelling, we may well be online, we don't really know what's happening at the moment, and also I'm kind of expecting Micro Pope number 2 to come out soon, so it might well be that I need to be at hospital or I need to be elsewhere in the first week. So I'm going to create a series of videos to help you through some of the more difficult areas of the development course. I got us to this particular point before Christmas specifically so that we could get to this point, which involves a lot of revision. So a lot of this stuff you can do yourself. I'm just going to be picking out the bits and pieces which you might not have seen before. Okay, if you need further resources, the resources which are relevant are the Tutor to You guide. That is there, that's page 65, and you can scan that. Don't know if you can scan that from there, but you can scan it from the Tutor to You guide there, or you can go through that way. It's from page 65. And also there is the handout as well, which I gave out to you last time. But both of those things will be outside my door, just on the other side there. So you can come and pick them up if you're in school. Okay, you'll need to be making notes as you go today. There isn't probably enough space possibly in the actual notes that I've given out. So it might well be that you need to take a separate set of notes using lined paper today. Right, so we're going to be looking at factors influencing economic growth and development. These generally are called barriers or limits to growth, limits to development. Before we start, we want to look at what growth is. Growth is an increase in real GDP per capita over time. And economic development, as we said before, is the increase in living standards of the whole population. And we're looking at increase in GNI at PPP per capita, health measured by our life expectancy, and education as measured by expected and mean years of schooling. I really feel like econ plus DAL now. I should have my. I've got the jumper. I feel like this is quite odd. It really is. Anyway, okay. So we've got a number of diagrams that we could be using as well. These limits could be limiting AD shifting to the right. That would limit our economic growth down here on the bottom. We could be limiting our LRS shift to the right. So it might well mean that our LRS is not moving. It might well mean that the quality and quantity of the factors of production are not increasing. It could also mean have issues down here as well. You could have issues with costs for firms and issues with revenues for firms. And that particularly is useful for paper 3. So I'm going to be using this unit to try to teach you about paper 3, to revise some of the things we've done before and get some really good technique going on, because I think that's something that we're a little weaker at the moment. Okay, let's look at the first factor then. First factor we're going to take a look at is primary product dependency. So primary products, we might well be looking at things like, for example, agricultural products, wheat, rice, something like that. We know that a lot of countries, like for example the Ivory Coast, some of the presentations you did, showed that we've got a lot of dependency on things like cocoa, coffee, things like that. The argument is that these products have an income inelastic demand. What does that mean? Well, for example, if we had an income elasticity of 0.1, that would mean that the percentage change in income divided by the percentage change in quantity demanded would be 0.1. Right, so, for example, if I had economic growth in my country, or actually more relevant in the world, let's say the world grew by 10%. If I'm producing something like cocoa, which has a 0.1 income elasticity, what we may well see then is that a 10% increase in your world income results in only a 1% increase in the demand for your good. So primary products generally, as world income rises, the demand for these products is going to rise at a relatively lower rate, or a proportionately lower rate. You could say that they're unresponsive or relatively unresponsive to increases in economic growth. If you're focused on these as your exports, you're likely to see limited increases in your own economic growth. You're also likely to see a limited increase in the price of these products. Say, for example, this is the price of cocoa. You're going to see over time very, very limited increases in the demand for these products, and therefore the prices of those products will rise at a relatively low rate. The quantity that you're selling is also going to be rising at a low rate, and as given that your export revenue is the price of exports multiplied by the quantity of your exports, that means that your exports are going up at a low rate. Or put it another way, this is limiting the degree to which your AD is shifting to the right. It is limiting your economic growth, increase in real GDP per capita. It's limiting the increase in the GNI of your country, and therefore it's limiting the increases in incomes and the reductions in absolute poverty that you require to improve economic development. So we've linked those both across. You could take this one step further, and there's a really interesting further area that you could take this, and we could think about other products. Now we could say that these guys are primary product dependent. That means something else. That means that you're not producing the things that you're needing to import. So other goods, for example, manufactured goods, say for example, you need to import some capital. You need some capital equipment in your factories to diversify your economy. I'm going to need to import those. But I know that they are likely to be income elastic. So, for example, if I have economic growth of 10%, it might well be that the demand for these goods rises, say, for example, by 20%. It's likely that the prices of these goods are going to be rising at a higher rate than the prices of these. For example, we could draw another diagram here. We could show that the demand for manufactured goods is going to rise at a significant rate. That boosts prices very quickly over time, and that means therefore that your import prices, if you're importing these goods, your import prices are going up faster than your export prices. Now that might mean something to some of you. That might suddenly ring a bell. What am I talking about? Terms of trade. Your terms of trade will be depreciating because as your export prices rise at a lower rate than your import prices, you have to sell more kilograms of cocoa for every machine that you import. So you have to work harder to import goods and services. If we take this one step further, these goods and services, this capital, which I've particularly chosen because you need capital to diversify. i.e., if you're going to move away from just making cocoa and you want to start making chocolate, you're going to need capital goods, machines, to do it for you. That would enable you to shift AD further, to have higher priced exports, but you're limited in doing that because the prices of these goods are likely to be rising fast. These goods are in high demand because they're income elastic. These goods are in lower demand, being income inelastic. Therefore, you're going to see a big barrier to development for these countries. This idea that we've just shown here is something called the Prebisch-Singer hypothesis, and the idea that primary products prices will stay low. Let's put that on the board there. Prebisch-Singer hypothesis, and that will result then in low or deteriorating terms of trade. so your average export prices over your average import prices, and it will result in low growth in export revenue. All of those are a barrier to those two, and therefore if you're primary product dependent, that could serve as a significant barrier. But you might well challenge this, and you might well think, well, why is it income inelastic? Are all goods which are primary commodities income inelastic? Well, we know that certainly cocoa is. We can only, our demand for cocoa is only going to rise at a certain rate. You can only have so much demand, so much cocoa. But the demand for luxuries is going to rise at a very much higher rate. We have an almost infinite demand for luxury goods as our income rises. But a country like Chile, for example, which produces copper and is primary product dependent in that area, has actually done really well from this. It has a relatively, that number for copper, I don't know what it is, but it's relatively high. It has found that copper prices have increased over time, and as a result, it has had significant increases in its exports, resulting in significant economic growth. The reason for that is that copper is used in a lot of electronic circuits, chips and things like that. So when you buy your mobile phones, which are a luxury product, it results in a significant increase in the demand for things like copper. It's also true that other countries can't produce it. There are only a certain number of countries in the world which have these large enough copper mines, and so therefore there's a limited supply, a big demand, and Chile has resulted in having a big demand for its exports. So it hasn't had a deterioration in its terms of trade, it hasn't had a low growth in export revenue, and the Prebisch-Singer hypothesis has not been proven to be true in that country. So it might well be that's the evaluation. If you wanted to evaluate it, you might evaluate by saying not all goods, not all primary products are income inelastic. So that's the eval. You want to challenge that. You want to challenge that number. Okay, and if it is elastic, then you will have a different scenario, and it won't be a barrier. Okay, let's talk about volatility. Our second area to think about is volatility of commodity prices. So we not only know that commodities or primary products, their prices are low, we also know that those prices will be volatile. That means that they go up and down. If you see the price of, say, wheat, that's price and that's time, you're going to see that it's going up and down all the time. It's very, very unstable. So why is it unstable? Well, one big reason is because a lot of these goods are agricultural. Agricultural goods, they're likely to be affected by supply side shocks. So a lot of these things are affected by weather. And so as the weather changes, you're going to see changes in supply. And as supply changes, the price changes. You're going to see also low barriers to entry. Pretty much anyone can produce a lot of these agricultural goods. And so if the price of those goods rises, you're likely to see a lot of people coming into the industry, dropping prices again. You're going to see a lot of excess supply and then excess demand, and it's a very volatile industry because of that. Okay, so what problem does that create? Well, as you have volatility, you're likely to see farmers with some significant issues. If we take this diagram over here, I've drawn this in perfect competition because this farmer likely has low barriers to entry, and therefore it's going to have a perfectly elastic demand curve. What we can show then, if you were in a paper 3 essay, you could show then that the world price of wheat, for example, going down, you'd have a diagram over here. You don't need to draw that right now, it's too complicated, but the supply curve would be shifting to the right. We could have had a really good weather. So let's say then the reason for this is good weather. And so therefore suddenly you have an increase in supply. That's going to pull the world price down, and you're going to see a new curve look something like that. Remember, these guys are price takers, so they take the world market price, like that. You're going to see a new MC equals MR over here, because you've got an MR1 over there. So we're going to see a new point down there. They're going to supply less. And we're going to see a new level of cost at C1 and P1. So what have we seen there? Well, as the price changes in world markets, you're going to see a firm possibly making that amount of loss there. That becomes loss. What we had was a firm before with the previous market price making a big profit. So we had supernormal profit, we had in the short term, we had good weather, increase in the supply, drops the price and moves this farmer into loss. So we have P, A, B, C, that was the profit in year 1, and then we have A1, B1. Just remember that in the exam you can't colour things. Moving to loss in the next year. Okay, so over here we could say then that this then creates profit, loss, uncertainty for firms. You don't know what you're going to be making. For consumers or for workers, you're going to have income volatility. You're not going to be sure what income you'll make next year. For governments, you're going to have tax revenue uncertainty. If you are taxing companies or you're taxing individuals, if their income's going up and down and profits are going up and down, you're going to see tax revenues going up and down. If your tax revenues go up and down, that means that you can't fund long-run investment projects. Your health and education projects that you want to fund are going to be limited. Your infrastructure projects will be limited. If you've borrowed, you've taken on debt, you're going to have a significant issue because you won't be able to repay the interest repayments on those debts, resulting, unfortunately, in possibly bankruptcy, possibly missing your debt deadlines, or not even doing these projects to begin with because you're not confident you'll get them back. Finally, you're going to see investments falling. Because you've got this uncertainty for firms, and because you've got an unstable macroeconomic environment, you're going to see investment falling. And as a result, LRAS does not shift as much. And as a result, you're going to see lower growth, fewer health and education projects. So this is really, really bad. It's very, very difficult to really deal with this source of volatility. We could go further and talk about all the other sorts of things that could happen as well. You're going to have to see AD being volatile. Remember, your exports are going up and down, and that shifts AD to the left and right. That means you're going to get inflation, or you're going to get recessions and booms. You're going to see also the exchange rate. In good years, when the prices are high, the exchange rate will rise. There's going to be more demand for the currency. In bad years, when the prices are low, the exchange rate will fall, it will depreciate because there's going to be a lower demand for the currency. And therefore, you're going to see even more instability for all of those up at the top there. So, for all of that, the key there is all sorts of different macroeconomic instability. Macroeconomic instability creates political instability. It can create the conditions for war as well. But it certainly means that you're going to invest less, and therefore the really bad thing is that as you invest less, ironically, you can't diversify into the manufactured goods which are not price volatile. The thing that you need to do to get away from this is to move into higher manufacturing tertiary sectors. But if you have such an unstable environment, you haven't got the conditions to do that. You also are not going to see FDI, foreign direct investment. Firms aren't going to be attracted to this country because it is all over the place. You have a lot of instability. So all the things that you're looking for to move away from commodities and primary products are not there because of those primary products themselves. If you couple that together with the primary product dependency, the fact that they have low prices, you have yourself a trap. You have a development trap that you cannot get out of unless you go for significant amounts of FDI, or you go for significant amounts of aid or other injections into your economy, which are going to make up for the lack of investment that you see. Right, brilliant. Let's get rid of all of that. Okay, these first three are ones that you haven't seen. We'll speed up a bit in a minute. But the first three, if I were writing an essay, I would certainly base my essay on some of these first three. And actually, in the past, this one here, number 2, has been a source of a lot of whole paper 3 25-mark essays. So we'll be looking at a 25-mark essay for volatility of commodity prices later on. Okay, next area to look at is savings gaps. These are quite simple. Essentially, it's quite common sense really. If you have low incomes, you're going to have low savings. A lot of these countries, you have low income, you have absolute poverty, you're going to have low savings. Now we know that savings in developed countries are put in banks. And when you put savings in banks, banks lend it to firms, firms invest, and you have this loanable funds available to create investment. And so you're going to see low investment there. Now the reason for that happening is multiple. First of all, you've got the low income, but also you've got no banking system. So if you have lack of a banking system involved there as well, the banking system, even if you did have incomes, can't pass it on to the firms and then can't create a system where you're going to get more investment, shifting LRAS, raising economic growth, raising GNI, and raising profits for firms. Right, okay, could we evaluate it? Well, you could. And there's something called the Harrod-Domar model. This is a little bit technical, but it looks great. Now you could be asked it on its own, but it's unlikely. I think it's more likely that you can use this to evaluate the problems of a savings gap. So the Harrod-Domar model is actually seems complicated, but actually isn't. So what you do, you take your savings ratio, you divide it by your capital output ratio, and that equals your level of economic growth. And this is referring to this diagram over here. You're essentially saying that this LRAS curve is moving out, creating higher levels of RNO, economic growth, and therefore development, because GNI is part of that. Okay, so in order for this to be high, I want this number to be high and this number to be low. So if I want high economic growth, I could have, say, a savings ratio of 2, a capital output ratio of 1, creating higher levels of economic growth. If I had it the other way around, 1 over 2, my economic growth would be low. Okay, so we're looking for high at the top, low at the bottom. Let's talk about the savings ratio. Well, we know that in many countries, the savings ratio is low. In developing countries, as we said before, because we've got low income, because we've got lack of banking system, that's likely to be low. So the number at the top of your formula there is likely to be low. Now the capital output ratio, that's a little more difficult. The capital output ratio is simply, if I have, say, £10 of capital, let's say £100 of capital, okay? I get a new machine which I bought through some of the savings which went to the bank, which went through to the firm. We bought £100 of capital. Every year, that capital produces £10 per year of growth, of output. Okay, that would be a capital output ratio of 10 to 1. And that is a low capital output ratio. That's low. Now, if you wanted a high capital output ratio, perhaps £100 of capital would create £1,000 of output every year. That would be a high capital output ratio. So why would a capital output ratio be high or low? Well, part of it is due to the type of capital you're using. It could be poor capital. It could just be poor technology, and therefore it's inefficient. So you're saying essentially that this is the productivity of your capital. Let's put a few notes down as what affects that productivity. That could be your labour. It could be the capital you're using itself. So it could be, for example, technology. You have poor technology, you don't know how to use it. Your labour could be unskilled. If you combine unskilled labour with really good capital, they can't fix it, they can't use it, and therefore you don't get much output from it. But I think those two are not really that important when you're considering developing countries. The really important one is actually infrastructure. And this is quite interesting. If you don't have an electricity grid, so for example, in Nigeria, you're seeing that electricity goes out a lot of the time. If that happens, your capital, your nice, great, big, shiny refinery that you just built, can't work. And so the output of that capital is likely to be lower. If the output of that capital is likely to be lower, your capital output ratio is lower. It could be that you have poor roads, and so the deliveries of land, of the raw materials to your factory get disrupted. That means your capital can't work. It could be that you have poor internet, broadband, and therefore you cannot get the orders in from your suppliers or from your clients. It could be all sorts of things. Many of these things, this infrastructure we're talking about, will raise costs for firms, and it will limit the ability of capital to produce. If that capital output ratio therefore is low, you're going to see a low rate of economic growth. Let's take that away and then explain, well, why is that an evaluation? Well, it's an evaluation because you could quite simply say, if you have a savings gap, you have a low savings ratio, that's fine as long as you have a low capital output ratio. So economic growth is dependent on two things. Even if you have a high savings ratio, if you have that one, a low capital output ratio, your economic growth is still going to be low. Okay? So you need both of those. You need that one to be low, and you need that one to be high. So economic growth depends on two things, not one. And even if you have one, you're going to have the other in order to make sure you have high economic growth. Taking it further, well, how do I get a higher capital output ratio? I think a lot of you probably have already seen, it probably comes back to the government. The government will need to have supplied infrastructure, it will need to have supplied good quality roads and electricity, broadband systems, ports, things like that, so that businesses can produce effectively. If it doesn't do that, you're not going to have that high capital output ratio that you need. Okay, it might also be useful to put some numbers in there as well, just to show it. Sometimes this one is the confusing one. That capital output ratio can be a little confusing as to whether it's high or low. If you were then to link it over to LRAS, that would be quite good as well. and you could show the economic growth as a result. It's not good enough though. By the way, I've just made a mistake there. I've just talked about economic growth. If you have a question which is economic growth and development, then you're going to have to then link it to GNI again and say, well, if you have this high capital output ratio, high economic growth, shifting LRAS, creating growth, GNI rising, creating higher tax revenues, resulting in the potential to raise health and education in your country, and raising the potential for economic development as measured by the HDI. So you've got to go that one step further in your logical chain of reasoning. Right, 4. What's 4? Right, foreign currency gap. Okay, a bit quicker now. So we know that foreign currency flows into a country for a number of reasons. You could get inflows of this due to exports. When you export goods and services, you get inflows of dollars into your country. Your local banking system will have dollars flowing in. It could be FDI, foreign country companies bringing money into the country. It could be aid, or it could be loans. Any country, as we saw before, if you're primary product dependent, you have low export prices. You probably have high import prices. Or you might be just in a bad year. Whatever it is, you could have a current account deficit. That means that your outflows of money from your country are going to be bigger than your inflows. That means that you could run out of dollars. If you run out of dollars in your country, then you're unable to buy imports. So you become less able to buy important medicine, possibly important capital goods that you need to diversify your economy, create economic growth, but possibly even to improve healthcare and other areas of economic development. So if you lack dollars or any other currency you need, it might be euros, you're therefore unable to import. In these situations, in foreign currency gaps and crises, the IMF often comes in, the International Monetary Fund often comes in and gives emergency loans, and it gives a boost to the country's financial account, which is necessary if you are then to continue to import goods and services. Whatever happens, why is this an issue then? Well, it prevents this increase in AD, or particularly LRAS. If these imports are capital, that limits investment. And we know that if you want to diversify your economy, the capital has to be high quality, and that capital is likely to be coming from abroad. And so foreign currency gaps are a big impediment, or they're a big barrier to development and growth. Great. Okay. You could also have something called capital flight. Here, please be careful with this. That's not capital as in machines. This is capital as in money. So we're just confusing our terms a bit here. If you have capital flight, that's probably due to some very high levels of inequality. You're likely, because of your primary product dependency, volatility of commodity prices, you're likely to have an unstable macroeconomic environment. If you have that, also because of the unstable banking system as well, many of the richer people in the country will like to save their money abroad. Many speculators, seeing that things are not going well, might well pull their money out of the country, and you see large amounts of capital flight. That means that you change your local denominated money, the local currency, whatever it is, and you change it into dollars. Those dollars are those dollars which are in the country at the time. So you go to the local banks, change it to the local dollars. Those dollars are then taken abroad and leave the country. That, therefore, is a withdrawal from circular flow. That withdrawal from the circular flow, therefore, limits growth. and it would come out of the financial account normally, possibly as part of speculation. That also has other impacts. You're going to depreciate the currency. What you're going to see is the currency, you're going to see the demand and supply. As you have capital flight, the supply of your currency is going to go up. That's going to pull your exchange rate down. We know that a weak exchange rate is going to result in higher import prices. Now this is where you start to get a current account crisis, because as capital moves out of the country, it crashes the exchange rate, it creates more volatility. That then results in more people moving their currency out of the country, creating massive inflation. And that is unfortunate, and many countries have gone into that problem. So you're in a very dangerous situation if you start to get capital flight. Just in the past few years, China has been at risk of capital flight. It's created capital controls to prevent this from happening and to prevent people moving their currency out of the country. But it can be very, very damaging. Okay, we could just finally, if we want to link it back, because we always want these links, we link it back to these two. That capital flight, therefore, limits economic growth. It means that there's less money in banks available for investment in your country. That means there's less LRAS shifts and less growth. It means that the exchange rate depreciation and things like that creates a further volatility to your macroeconomic environment, again, limiting investment. And that limited investment means that the government is then less able to provide health and education, and there's going to be less increases in GNI as well, therefore limiting economic development. Brilliant. Okay, demographics. Now in the Tutor to You guide, I think it goes completely off topic here and starts talking about aging populations in developed countries. It's got nothing to do with it. We're talking about development. Development, the big issue here is large populations. High population growth is likely to create strains on a country's public services systems. So it's often the case that if you're in poverty, you would have thought that if you're poor, you have less children. It doesn't really work like that. Women who are less educated start to have children earlier, and if you have children earlier, you have larger families. So poverty often results in lack of education, lack of women's empowerment, and then higher family sizes. You're going to see, if you're into geography, possibly you are, you would want to maybe talk about the high dependency ratio, the number of dependents which are based on each adult. So basically there's a large number of children who are being supported by the working population. If you've got a high dependency ratio, that means that higher family sizes results in what we call intergenerational poverty traps, because higher family sizes means that you can't pay for your children's education. So the education and healthcare that you see is likely to be weaker. If you've got weaker education and healthcare, you're going to therefore get weaker economic development. There's less resources available per capita. Remember, this GNI figure is per capita, per head of the population. If you've got 10% population growth and 10% economic growth, you have zero increase in your GNI per capita. So that creates a much more pressure on your economic growth to catch up, which is why, for example, the Chinese one-child policy, reducing the population growth, is actually quite a, well, I mean, in many cases it's not a good policy, but in terms of economic development, it might be an intelligent policy. It means that each child can gain more in terms of educational resources, therefore improving the quality of your capital, your human capital, I should say, and shifting LRAS to the right. So that really limiting population size is key. Now, To evaluate that, it's not all countries who are developing who have large populations or have large population growth. So this demographic factors really depends on your education in itself. If you have good women's education, good reproductive education, where people know how to use condoms, for example, you're going to see less population growth, and this is going to be less of a factor. So this is not necessarily a situation in developing countries. It can be changed, and it's actually not too difficult to change it. Just a bit of education and some economic growth generally tends to reduce population sizes or reduce population growth. Right, 7, external debt. If you're feeling tired at this point and you've had enough of me rabbiting on, I've got 40 minutes of me so far. It's a little too much, isn't it? Take a break and have a cup of tea or something. But if you're still here, please. Of course, you're still here. What am I talking about? But if you're losing concentration, just take a break at this point. Okay, debt. So here we're talking about external debt. A lot of countries have debts which is denominated, for example, in dollars. So if I'm Zimbabwe, or a good example is Iceland, actually. Iceland had a lot of debt before 2008, which was taken from international banks, and it was denominated. That means it was taken out in dollars. So that often is the case. You see external debt being from governments. Governments, remember, they have weak tax systems. They're not able to collect tax. Their incomes in the country are low. So that means that you have a limited amount of profits. You have all this volatility in profits from companies who are primary product dependent and have volatility in their commodity prices and all those sorts of things. Which means that governments often have budget deficits. In order to fund capital projects, they often take out external loans from international banks. Now, guess what? You are a macroeconomically unstable country, you're going to have a low credit rating. Low credit rating means high interest rates. And so you're going to have to be able to service this debt. Now, debt in itself isn't a problem. If you've invested that into something which is worthwhile, so for example, a new road, a new high-speed railway, or we saw in Morocco, they've invested into lots of new, probably quite good things there. And the return on that investment is high, you can use the economic growth that that infrastructure creates to pay back your loans, and that's fine. But if you have a lot of corruption in your country, or you don't succeed in building the things that you wanted to, you allocate it to the wrong projects, in the future, if your economic growth doesn't rise, you don't have the money to pay these loans back. If you don't have that money, therefore you're going to have an issue in paying it back. And particularly in recessions, or if the exchange rate falls, you're going to struggle to pay it back. I was going to say, it's generally governments, but it could be also individuals as well. Individuals could take out loans as well. Okay, they become an issue if there's a depreciation. That becomes an issue if there's a depreciation, because as your currency depreciates, you used to have, say you needed 10 per dollar, you needed 10 of your currency to buy $1. Now you need 20 of your currency to buy $1. Essentially, the value of your debt in your own local currency has doubled if your exchange rate falls and halves, for example. It could also be a problem if you're in a recession as well. Both of those things mean that you could struggle to pay your loans back because you have less tax revenue, or you need more of your locally denominated currency. All of that means that, well, there's an opportunity cost. That opportunity cost is going to be, you're going to be using more of the government budget to pay back your debts and interest. That's going to mean that you've got less money to pay for health projects, less money to pay for education projects. They're the next best option which has been foregone, to use a definition of opportunity cost. And therefore, that's going to limit economic development. Could also limit economic growth because you have more, you have less government spending, limiting AD shifts, limiting LRAS shifts. But again, the key thing I said there was that not all debt is bad. The evaluation has to be that some debt is good if it's invested in the right place. So the eval is, what was the investment? If it was good investment, we're creating economic growth, then it's okay to have external debt. Brilliant. Some of the issues which have arisen from that, we've seen that debt cancellation, for example, rich countries cancelling the debt of poor countries, so avoiding what we call debt traps and therefore allowing them to sort of reset their growth again. Okay, just 3 or 4 more now. So access to credit and banking. I don't think there's too much to say here, other than the sense that many countries don't have a banking system. If you don't have a banking system or a functioning banking system, that would mean that you are unable to take the savings in your country and lend it to firms, and therefore they're unable to invest, limiting LRAS shifts, limiting economic growth, limiting increases in GNI and PPP per capita, limiting economic development. It also is quite interesting that if you want to go and get a bank loan as a woman, you're going to need, well, as a man or a woman, you're going to need something called collateral. Collateral is your wealth, something that you own, like a house. If I go and get a loan, I'm going to need to put something up and say, if I can't pay it back, here's something that the bank can take. And so that collateral is really important. It's often the case in developing countries that women don't have collateral. Women cannot own anything. And if you can't own anything, you definitely can't take out a loan. Can't take out a loan, you can't set up your own business, and you're then trapped in your own poverty. So access to credit and banking is really an issue, particularly for women's rights, and a lot of microcredit, which we'll see later, is designed to try to resolve that issue. Okay, infrastructure. Many countries, we've alluded to this already, have poor infrastructure. We said that the savings gaps in the Harrod-Domar model meant that the capital output ratio was low. That's partly because of this infrastructure. If you have weak infrastructure, you're going to see that firms are going to be impacted quite badly. Weak infrastructure results in costs for firms rising. So what I could do then is I could, if I assume that these are fixed costs, just to make my diagram a bit easier, I could put a new ATC curve up there, ATC1 with weak infrastructure. Basically, I have, for example, I have no electricity, or my electricity system is not very reliable. Therefore, in many developing countries, I'm going to need a generator. I need to buy my own diesel generator. Every company needs to have them, increasing costs. I have weak roads, which means that it takes 3 days longer to get to port. That's money. Time is money, isn't it? It takes longer it takes more petrol, it takes more diesel. All these things increase a company's costs. And as a result, you could have a company originally making a profit, but in this scenario, they're going to be making a loss. That area there, if you have weak infrastructure, raising their costs of production, you're going to see losses occurring. If losses occur, you're going to see less investment and you're going to limit FDI. So weak infrastructure does a lot of things. It raises costs. That limits profits. It could also possibly limit the education of the country through poor broadband, for example. That limits investment and therefore economic growth and diversification. It also limits a FDI. If you want a company to come to your country, you're going to want to have good infrastructure. That's more likely for them to make profit. Now, if you have poor infrastructure, it's interesting because you're only really going to be attracting FDI which is extractive. It's unlikely to be FDI creating inclusive growth. The more infrastructure you have, the more likely that the FDI that you get is going to be based in local economies. It's not just going to be some expats go to your country, extract the resource and then leave, because they can't interact with the local economy. They don't have the ability to move their products around the country, and so you're going to really limit the trade and inclusive economic growth that comes. Finally, you're going to create an issue in the labour market. You're going to see geographic immobility. Geographic immobility being the fact that people in the countryside, because there's no roads, probably no broadband or internet, they can't move to the cities or they can't work online. Meaning that you have low wage rates in the rural areas, high wage rates in the cities, and significant inequality. Meaning that economic growth suffers because that geographic immobility creates structural unemployment, resulting in less output, meaning that that geographic immobility also means that you have more inequality. It also means that these people in the countryside can't have health and education. They can't afford health and education, resulting in lower levels of economic development. That's all an issue. And if you were to create a nice diagram that you could draw, is the supply of labour and the demand of labour. A nice diagram could be that as you increase the provision of infrastructure, the supply of labour is going to increase in the cities. This is the wage rates. This is the... It's going to pull wage rates down and make your country more, what's the word? Sort of more competitive, better international competitiveness. That could raise exports because your export prices would fall, and that would shift AD, that would shift LRAS, and so on and so forth. So infrastructure, really big issue, but if you have infrastructure, that will allow you to move away from possibly producing commodities. It will give you more FDI and it will give you more growth and development. Brilliant. Right, almost there. What do we do next? Got education and property rights. Education is really obvious. We've done that lots before. That's just simply the quality of your human capital. A new word for you there. You've seen it in geography. If you have weak human capital through weak training and education, you're likely to be limited as to the amount that your LRAS can shift. Remember, human capital is a factor of production. If you improve your human capital, you're likely to shift LRAS and create growth. But this is really important because you can see that education and GNI are both measured in HDI. If you provide education, you are improving directly the quality of life of the population while allowing GNI to rise through incomes, but also improving health, because education often results in higher health outcomes. Hygiene, for example, sanitation, all those sorts of things will directly improve that as well. So just talking about sanitation, I forgot to say, is infrastructure. And so infrastructure can have a direct impact on economic development if it improves health as well. Okay, so lack of human capital is going to really affect economic development directly. Again, it could also limit FDI. If you don't have very good human capital, companies are not going to want to come to your country. It's going to result in a limited, what we said before, capital output ratio. You could say, in another way, the MRP, the marginal revenue product of your labour, is likely to be low. That's going to therefore limit the output of your country. If you wanted to diversify, for example, if you wanted to diversify into tourism, for example, you're going to need to be able to speak English. If you can't do that, you can't therefore diversify and go into higher value areas, and therefore you're going to be subject to those two at the top there. So, all the problem. This is really hard, isn't it? Because all of them limit all the rest of them. If you have all of them together, you're in a massive trap, and it's very difficult for you to get out of. And just focusing on one of them isn't really going to help you, because all the rest of them will continue to limit that one in having any effect. Okay, finally, absence of property rights. It's less likely you'll see this. You might have seen this. You might have seen it possibly in externalities in micro. But absence of property rights essentially means that if you can own a business, so if you're able to own your own land or your own business, that results often in more investment, it's more stability. So the ability to ownership of businesses or land, if you are able to own those things and people can't take them away from you, you're more likely to invest. It's also likely that there's going to be less corruption, because if people own things, it prevents others from taking them away and taking land grabs and things like that. It also means that the environment is likely to be better, because if people own things, they'll be more responsible about them and they won't pollute them. And so you'll see that there's significant pollution in previous communist countries because all those things were state-owned, and so people didn't take responsibility for them. So lakes and things like that, if people own the lake and they make a profit from that lake by having tourism or having jet ski business or something, I don't know what I'm talking about, but if you had some sort of business which used the lake there, you would then have an incentive to keep it clean. So it has environmental benefits as well. All of those things, investment, shifts LRAS, and therefore promotes economic growth. Economic development, interesting, we haven't talked about the environment very much. HDI doesn't measure the environment, but the environment could be a direct impact on economic development as well. So absence of property rights, or property rights in general, might improve the environment too. Right, that's an awful lot to go through. I hope that a lot of it has been more of a revision than anything, but the key things I've done today is that I've linked all of these 11 things across using logical chains of reasoning to those two at the top. It's likely that you're going to get a question saying growth and development. You can't get high marks if you don't do both. You have to link across to both of those concepts. If you don't, you're just throwing marks away. Likely that this is going to come up in the data response, so you're going to get some more data. I've been less heavy on evaluation today because it's the data in the text which will allow you to evaluate and say, well, actually, this country, although it has a savings gap, it's had a lot of aid for infrastructure, and therefore that will outweigh it, or whatever you want to say. So yes, you would need to apply these ideas from the text. These diagrams, just be careful. This is paper 3 only. Just be careful with those. We'll talk about those more later on. Okay, brilliant stuff. I'm going to set another set of things based on this. So I'll set some other work based on this for you to do. Got some example questions for you to see as well. Thanks very much for listening, and I'll see you next time.